All right, so Chapter 7, our focus is on internal control. And before we talk about internal control, I want to talk about an audit of the financial statements. So if a company wants to bring on an investor, or they want to go to the bank and get a loan, okay, the investor or the creditor doesn't want to give the company money if they feel like they're going to lose their money. So they want to be assured, the investor, that they're going to get something for their money. The bank wants to make sure that the company's going to pay back the loan and make the interest payments. Okay, and so the company's going to have to show their financial statements. And the bank or the investor isn't going to want to just take the company's word for it that they follow generally accepted accounting principles. They want somebody from outside the company to say, yes, these financial statements were prepared in accordance with GAAP. And so that's what an audit of the financial statements provides. So a public accounting firm is a firm that works for all different clients, and they will perform audits, other services. A small public accounting firm may do bookkeeping or compilation. Compilation is when the company keeps track of the journal entries, and then the public accounting firm will then put together the financial statements. A review is a less stringent form of an audit. They prepare taxes. They will do consulting. And so an audit of the financial statements is when the public accounting firm, this independent third party, comes in and examines the financial statements and issues an audit report. And the audit report is where the public accounting firm gives an opinion on whether or not the financial statements are fairly presented. So this is what an audit report looks like in so this is when you pay for an audit, you're paying to get these 3 paragraphs. Actually, this sentence here is what they're really paying for. In our opinion, the financial statements referred to above present fairly in all material respects the financial position, so that's the balance sheet, and the results of his operations, that's the income statement, and its cash flows we haven't learned about yet, but the statement of cash flows we will learn about. Okay, in accordance with accounting principles generally accepted in the U.S. Okay, and so the auditor is not saying that these financial statements are 100% correct. They're probably not. There's probably errors in there. But material respects, they present the financial statements present the company fairly. A couple other things that are important. It says, these financial statements are the responsibility of the company's management. The auditor doesn't have anything to do with the preparation of the financial statements. They need to be independent. They conduct their audit in accordance with auditing standards. So we've got generally accepted auditing standards, just like we have generally accepted accounting principles. And then here it says an audit includes examining on a test basis. Okay, so where they're not looking at every single transaction. Sometimes I have students in class that have worked with auditors. Maybe some of you have worked with auditors if you have something to do with your accounting function. And so the auditors will come in and they will ask to see certain schedules. They'll pull invoices, various things to test the financial statements. Okay. And so the purpose of the audit is to reduce the possibility that the financial statements will contain a material misstatement. So it's not eliminating misstatements from the financial statements, it's reducing the possibility that there is one, right? Because the auditors are not looking at every single transaction. They will look at a statistical sample of transactions. Okay. And then when we're talking about material, we're talking about the relative importance of an item. So would the misstatement cause the stakeholder to make a different decision? So usually it's material is based on a dollar amount. If it's a big enough mistake, then perhaps the investor won't give the company money if they had known about it, or the bank would not have made the loan if they knew about it. So the steps in conducting an audit, the big one, they do is the planning and risk assessment. And so the more work they do at the planning and risk assessment, the less they have to do later on. So they need to understand the company, they need to understand the industry of the company, they need to understand what's normal for the industry. And so they also need to determine the audit risk. What's the chance that they could issue the wrong opinion? And that will determine how big of a statistical sample, as well as the size of the company, how many transactions they need to look at. They will conduct internal controls testing and then substantive procedures. Okay, so they will go and they will perform procedures. Basically, they'll verify all the balance sheet accounts. So they'll look at cash. They will, verify cash balances. For accounts receivable, they will contact a sample of the customers of the company and have them verify their account balance to see it matches what the company shows. For inventory, they will be involved with the year-end counting of the inventory. Okay, so those are all the substantive procedures that happen as part of the audit. And then, based on the results of those substantive procedures, they will issue the audit report. And the company hopes it's going to be this unqualified opinion here, where they say they present fairly in all material respects. That's what the company is hoping they will get from their audit report. So let's take a look at internal control. We said one of the things here is internal controls testing. What is internal control? So the company needs to have procedures and policies in place to safeguard their assets, to prevent theft or fraud or misuse of their assets. So I mentioned this back when we talked about inventory. Some internal control procedures for inventory was the concept of having the purchase order authorized, to have a receiving report prepared, and for accounting, they need to match the purchase order, the receiving report, and the vendor invoice. So those would be internal control procedures. Okay. We want to encourage employees to follow company policies, more specifically, obey laws. So if there's environmental, safety regulations, or Sarbanes-Oxley that we'll talk about in a minute. And then we want to make sure that the information is accurate, that we're recording things accurately, that we're capturing transactions, that they're being recorded, and that they're being recorded correctly. We want to make sure that journal entries aren't being made to conceal fraud. So let's talk about the elements of internal control, or the components of internal control. And so the book was creative. They used the acronym CRIME for the 5 elements or 5 components of internal control. So the C in CRIME stands for control procedures. So these are the specific procedures that are used for internal control. So first off, we have to have competent personnel. So people that have the knowledge to do their job. They need to have the training so they know specifically what their job is, and then they need to be supervised. Okay. Assignment of responsibility. So every employee is responsible for certain tasks, so that we know everything that needs to be done is being done because there's an employee that knows it's their job to do it. Separation of duties is really important. We need to separate the operations from accounting and separate custody of assets from accounting. So the accountants shouldn't be out there filling orders, okay? Because then they can do something fraudulent and then they have access to the accounting records. Separate custody of assets, so you shouldn't have access to cash or inventory as well as the accounting records. So if you were, stealing money, you could then make journal entries and make phony invoices to make it look like you were paying bills when actually you were just putting it into your own bank account. So that's what we mean by separation of duties. You want to have different people involved. One thing some students will tell me sometimes in class when we're talking about separation of duties, I've had students tell me that when they worked at McDonald's, they knew what the number 6 value meal was. So when the customer ordered it, they would just tell them, well, okay, that comes to $6.38, and they would never ring it in. They would then just go get the food and fill the order, and then they'd put the $6.38 in their pocket instead of the cash register. So that's why you want to separate duties. So the person that's taking the money should not be the person, that then I think they fixed that since then, although McDonald's doesn't have great internal controls. My daughter used to work there. But then no one will make the food unless it goes through the system, right? So somebody else sees that there's an order and makes the food. So they need to be separating those things. Audits, internal audits and external audits. If you're a large enough company, you'll have an internal audit department. So you will have company employees that will be going and pulling invoices and testing internal controls and testing transactions and verifying accounts receivable balances and so forth. If you're a large enough company. And then the external auditor will come in as well. You'd rather find the mistake yourself. You really don't want anything fraudulent to be found by the external auditors. If you have an internal audit department, that's going to deter fraudulent activity because they're going to be coming more frequently than the external auditors that are only going to be doing their audit procedures once a year. If you know every 3 months, the internal auditors are going to be by asking you for schedules and pulling invoices and such, then you're going to get caught. Documents, we need to pre-number documents, so then if a document goes missing, we need to account for it, right? Because that's when, as I said, somebody could be making fake invoices. Electronic devices, e-commerce, right? We know a lot of things now. There's hackers. We'll hear about company that has been compromised. So companies need to be spending a lot of money for cybersecurity measures to make sure that hackers aren't coming in and stealing or, changing their accounting information. Other things that we could have, fireproof vault, cameras. So even small companies have cameras that they're watching their companies. As I said, my kids worked at McDonald's or Dunkin' Donuts, and the owners of the franchises would have cameras when they weren't there. Loss prevention specialists, rotating duties and mandatory vacations. So you want to have someone else stepping in and doing that person's job because then they see what's going on. Okay. So that's going to be really important. If you're doing something fraudulent, maybe you don't want somebody to come in and do a job. You say, oh, I'm not going to take my vacation. And people think, oh, that's a really dedicated employee. And it's not. They're just trying to cover up their fraud. The R in crime is risk assessment. So you have to look at your operations and identify areas that are vulnerable to theft and fraud. So example, cash and inventory, those are things that people want to steal. So you want to have a lot of controls over those areas. Okay. If you have a new computer system, that could be very vulnerable because you don't know all the loopholes in that system yet. Okay. So information system. So you want to have controls in place so that people can't come in and make accounting entries and change things to cover up fraud. You want to have approvals for things built into your system. And then monitoring of controls. So you can have these internal controls in place, but then you need to monitor and make sure people are actually following these controls. So you want to go through and pull invoices and make sure that the purchase orders are being authorized. Maybe you have returns that need to be authorized. Okay. And then the last element of internal control is environment, management's attitude towards control. You can have the best policies in place, but management has to require that you follow those policies. You can't say, we don't need to do that, it doesn't matter. Management has to say it's important.